Why do you think hedge funds succeed so much even though 95% of day traders fail? My name is Hayden. I have about 2 years of trading experience. I'm going to tell you exactly why you're destroying your chances of becoming a profitable day trader. Many day traders will blame outside problems, such as an ineffective strategy, not enough starting capital, or sometimes a bad mentor. That the majority of times, the problem is not on the outside and is actually an internal problem. Your emotions are one of the most important things when it comes to day trading. If you can learn to effectively manage your emotions and have good psychology while you trade, you will have a significantly higher chance of becoming a profitable day trader. Many retail traders are just trading by themselves and they have no one to help them stay accountable for their own actions. However, hedge funds have teams that specialize in keeping day traders' psychology in check. A tactic that hedge funds have to maintain good psychology amongst their traders is to close a trader's account if they're not trading with good psychology. If they lose money and they become emotional, they close the account to prevent them from entering again to try to make that money back. The majority of retail day traders will choose when and when not to follow their rules depending on how they're feeling in that moment. And this is why maintaining good psychology and having a good mindset when you're trading is the most important factor that you can have to becoming a profitable day trader. And that's the purpose of this video, to give you guys good tips and strategies to maintain good psychology and a good mindset going into the trading day and maintaining it throughout the week so you can stay consistent, you can stay profitable, you do not take bad trades, and you stick to your rules and your strategy. The first sign that you're trading with your emotions is that you cannot get yourself to write down your strategy on a piece of paper. Ask yourself this question: can you write down your strategy on a piece of paper and follow it to a T throughout the trading day without breaking those rules? If the answer is no, you are trading with your emotions. The majority of retail traders just wing it and have no strategy and hope that they're going to get lucky. That is not how the stock market works. You have to have a good, consistent strategy with good psychology if you want to win in these markets. You cannot wing it and hope for the best. That's gambling. If you want to do that, go to a casino. You might have better luck. If you expect yourself to be making consistent money, yet you can't write your strategy down and follow it consistently, you're never going to make it in this game. It's like trying to bake a cake without a set recipe. Sure, you can throw ingredients in and hope that it'll turn out good, which some of the time it will, but the majority of the time it won't, and it'll end up a disaster. The majority of professional, consistent day traders have a written down strategy that they follow consistently. They will only trade that strategy and will only trade perfect setups with that strategy. They will not wing it and hope for the best. Write down your strategy and stick to it consistently. Stop winging it, stop hoping for the best. That's gambling. Go do that at a casino, not here. And this takes us to the second sign that you are an emotional day trader. You cannot just turn off the charts. The majority of day traders will lose a trade, possibly 1 or 2, even 3, and then try to enter again and try to win that money back. I'm a perfect example of this. I've done this before multiple times, and it's never worked out for me. I always lose more money than I expected to on that day. When you feel like you have to revenge trade to make that money back, that will lead you to taking trades that you would never normally take, which means you have a much higher chance of getting stopped out and losing more money. This is why it's never a good idea to revenge trade. Now, sometimes these revenge trades will win, but the majority of the time they will not, and you will lose even more money than you would have been okay with going into the trading day. And believe it or not, the small amount of winning revenge trades are actually horrible for your psychology. Now you might be asking, how is winning a trade ever bad? The goal of this is to make money, right? Not to lose it. So if I'm winning, I'm doing something right? No, that's wrong. It's common to think that, since the majority of traders start doing this because we want to make a lot of money. There's a lot of money to be made here, and we're all eager, me included, to make a lot of money. However, that's one of the main problems with this. We cannot be trading to win money. We have to be trading to win. We want to keep our win rate good, so we have to rely on good, consistent winning trades. Forget about the money. The money will come later. We have to focus on finding good entrances and good exits and getting out. We want wins, not money, because the money will come with the wins. Falling into this trap of revenge trading is horrible for your psychology and your future strategy. For example, if you win a revenge trade by breaking your rules, that will lead you to think and believe that the rule that you had in place is not even important anyways. So you will end up removing it from your strategy, and then you will just continue to lose and lose and lose in the future when you trade off of your new rules because you've changed them based off of that one winning revenge trade. This is why it's horrible to revenge trade, and you should never do it. Stick to your original strategy that works for you and don't change it. I'm a perfect example of this. This is what I did before I came to my current strategy, is that I ended up trading my old strategy because I was revenge trading. I was modifying it as I was going on until it just didn't even work, and I forgot what my actual strategy was. I ended up not writing it down, and it led to me losing a lot of money, losing a lot of trades. And that takes us to the third side. You're an emotional day trader. If you are happy or sad after a win or loss. Here's something I want you guys to do. Next time you take a trade, I want you to write down how you feel in that moment. Excited, happy, nervous, maybe mad, a little bit angry. These emotions are very normal, very common when we first start trading, because this is real money that we're dealing with. We want to win and we're scared to lose. That's just the reality of starting day trading. What we have to do is we have to get past that point. We have to overcome those emotions and those feelings to become essentially emotionally numb to all this, and that will allow us to take better and smarter trades to decrease our losses and increase our win rates. Being excited or upset inherently isn't a bad thing, but allowing the stock market to dictate how you're feeling, that is the problem. We can't have that. We have to overcome those feelings and become, like I said, essentially emotionally numb to this so that our emotions are not affecting our decisions in the stock market. I'm going to give you guys 2 examples of 2 different day traders. The first day trader is a retail day trader with 2 months of experience. He gets excited by wins, upset over losses, and when he wins, he feels so good, he gets tons of dopamine that he strives to get that feeling every day, even if the stock market does not have the ability to produce that. When he loses, he becomes very upset, and leading to the next day, He comes back with revenge. He wants to win. He wants to have that feeling and joy of winning. However, that leads him to break his rules again, and he loses, and he loses, and loses over and over again. And then he falls down a rabbit hole of depression and failure. He was never able to succeed, all because he had bad psychology, bad emotions. You cannot be excited over your wins and upset over your losses. Like I said earlier, wins are guaranteed, losses are guaranteed. The stock market does not move how you want it to move every single time. Now, for trader number 2, he's a retail trader, he has 5 years of experience, and he has mastered his strategy and his emotions. He expects wins and he expects losses. Expecting both of them to come naturally means that neither of them will surprise him. Monday, he ends up losing a trade. He simply gets off and decides to come back tomorrow. This is a great piece of advice. If you lose a trade, just go take a walk, go do something else, take your mind off of it. Whether you win or lose, this will help you become emotionally numb to wins and losses and will help you in the long term. Even though he lost, he expects that to happen and knows that if he continues to follow his rules and his strategy, he will make money over time, not on a day-to-day basis. As day traders who want to be profitable, we have to extend our time horizons for our profitability. We cannot limit it to 1 week. Okay, by the end of this week, I will be winning trades, I will be profitable, I will have a good win percentage. No, we have to expand that, make it larger, 3 months, 6 months, a year. This is what we have to do because on the long term, that is what we're looking for. We're looking for long-term consistent results, not short-term results. And this takes us to the 4th sign that you are an emotional day trader. And this one hits personal for me. If you move your stop loss or extend your take profit, we have all been in a trade where price just barely ticks the stop loss and ends up reversing all the way up to where our take profit was. So we go into the next trade thinking, okay, let me just move my stop loss a little bit farther away to give price a little bit more room to work with. And what do you know? It ends up working and goes straight to take profit. Barely misses your stop loss, but you're happy because like, oh, this works now. I moved my stop loss, gave more room to work with, and it hit my take profit. However, this is a problem because next time you take a trade, what does it do? Barely ticks your stop loss and moves all the way up to take profit. So as you see, this cycle will repeat and repeat and repeat, and over time, our stop loss will just get farther and farther and farther away until one time it doesn't reverse up to our take profit, and it will crash right through our stop loss. We forget a lot of the time as traders that our stop loss is there to protect our accounts. If we keep moving our stop loss back and back and back and farther away from where we originally had it with our strategy, we could risk blowing our funded account, blowing all the starting capital that you had, losing more money than you wanted to in a week. Now you can't pay for the things that you need to. We have to understand that our stop loss is there to protect us and our take profit is there to get us out of the market before it reverses down to our stop loss. This leads to take profit extension. We get greedy sometimes as traders. It's inevitable. We see the price starting to move fast. We're like, okay, it's moving very fast. Probably not going to slow down. Let me extend my take profit to make even more money. What ends up happening from there? Well, price hits where our take profit originally was, maybe moves up a little bit more before crashing right down. We lose that money that we could have made when we could have had a $500 profit and we extend it to $750 and it hits 500, but it goes a little bit higher to 625 and then crashes and we lose the money that we could have had. That is horrible for our mentality. We cannot do that. We have to secure our profits that we originally want to get. There's a reason that we are placing our take profit at the place we do, to get us out of the trade as fast as possible. The stock market is volatile, which means it can change at an instant. So we have to understand that and be smart and responsible and exit when we say we're going to exit and enter when we say we're going to enter. We have to have a set in stone procedure of what we are doing and what we are not doing. And that is one of the things we're not doing. We're not going to extend our stop loss and extend our take profit because that will increase the amount of losses we have and significantly decrease the amount of wins we have. And a good example of this is the story of Nick Leeson and the Barings Bank collapse in 1995. Leeson kept doubling down and hiding losses instead of cutting them. He had no stop discipline, and when the Kobe earthquake triggered a market move against him, he lost 827 million pounds, wiping out the entire 233-year-old Barings Bank. That's not just losing personal money, it destroyed an entire institution. I hope you all found this video extremely insightful and very helpful to your trading careers. I'm guilty of everything that I've said on this list, and I have worked very hard to get out of these and get a good psychology and mentality when I'm trading to avoid these losses. So these are all things that I had to change for myself, and I encourage all of you to work on fixing this yourself. Thank you all for watching. I hope you found this very helpful and insightful, and I wish you the best of luck on your trading journey.